All right, here we've got one too. Now, I've actually got a little bugbear myself about retirees. I think it's disgraceful that if a retiree if someone in the years towards retirement turns up for a job interview, they can't be prejudiced against for their age. But if you go to a bank, they will say that you're too old for a loan, and I have a massive issue with that. So we've got Carmen here. She's got low income and some line of credit, so she's retired. She is a low risk. She doesn't want to go high risk. She has some commercial property, which is where she gets her income from. So with the income from that, she's been able to extract $300,000 worth of equity, and she wants some further income so that she can travel and not concern herself. What can she do?
So she's retired and she doesn't have any income at all.
She has some income coming from commercial property. But she's used that income to extract $300,000, and she has $300,000.
She's got $300,000 sitting there ready to go.
Yeah.
She can do lots of stuff. First of all, she could do cash deals and say, bugger the banks. She could do cash deals. She could do low-end deals. She could continue to build that up. She could actually do turnover deals where she built that $300,000 up in value, and be active in the market. She could also do high cash flow deals where she looked at buying direct cash cows, and the immediate income coming in from those properties, the banks would actually look at that as being some income towards being able to service the loan, and therefore the next time around, she would then be able to count that income as her income for servicing the next loan. So income is her weakness, not equity. Income is her weakness. So what she has to do is focus on income and probably focus on strong, high income, which might mean the mining towns and things like that, where the banks look at the property and go, you know what, this is just such a good income that, the loan might only be 70% loan, not 80, but she should be able to get into that. And then next time, she'll actually be able to count that as her income, taxable income, to be able to get the next loan to go into the next deal.
So commercial property?
Commercial property also. It doesn't have to be commercial. It could be just residential property as long as the leases were strong enough and long enough. But if it was commercial property, then commercial property actually takes her out of a lot of the restrictions regarding residential properties, and it's the yield on the property that is actually looked at more so than who stands behind it. So a commercial property would be an easier mark for her because she'd be able to use the income on the property for serviceability to get the loan from the bank. And I just thought of something else there. I lost it. So commercial property, high yield residential property, cash deals.
With tenants that have long-term leases.
Totally, tenants with long-term leases. She could also do joint ventures with other people, or this is what I remember I was just going to say to you now, or she could start to do things through superannuation. Because in superannuation, it doesn't count your income, it counts more the property. Your age does come into it to some extent, but provided the property is a good, strong cash flow sort of property, if you've got money in superannuation, it's often easier to get a loan in super than it is outside super.